Good evening, students. Welcome to the live coaching classes organized by Board of Studies ICAI. This evening, we are going to have our second discussion on this topic called types of duty which are applicable under customs law, along with the classification, how the goods have to be classified under customs law. This classification rules are carried into GST law for the purpose of understanding how goods have to be classified. So the rules of interpretation, what are there in customs law, are brought into my GST law as well. So before we start with our discussion, let me have my confirmation with respect to availability of audio and also the presentation and video is clear. If I can have confirmation quickly from some of you, we will go ahead with our today's discussion. And there is one question which I have not got in the last session. There was one question from Namita which I couldn't answer. Like after the session got over, this question got popped up. Namita is asking this question. Sir, in relation to section 15, any other cases mentioned? It is not clear. Okay. So this section 15, Namita, if you see, this is helping us to determine the rate of duty on a particular event happening, right? Let me come to the respective page for helping you to understand with respect to the point, any other goods. Yes. Students, come to page number 1.24. Namita is asking this question. Sir, in page number 2.4, 1.24, there are three entries. First is for home consumption. Second is for warehouse. Third one is for any other goods. So if it is not meant for home consumption, it is not meant for warehouse, any other goods, the date of payment is determined. Now, this could be a case, Namita, where, say for a moment, there is a pilferage. The goods have been identified and have been restored back. So usually what happens whenever the goods have been unloaded, and before the proper officer passes an order, there was a loss of material to some extent, petty theft, which is called pilferage, section 13. So in the process, what happens when the importer clears the goods, this pilferage was identified and restored back. So in that case, Namita, any other goods, the date of payment of duty, the day when you make the payment, that rate shall be applicable. So this is to your answer, Namita, for the last session, which I have not answered. Yes, Sarah. Thanks for the confirmation. Priya and Naveen, yes, thanks for the confirmation. Thank you. Now, there is one question. Quickly, I'll take this question from Naveen. What he says, sir, as per section 12, we can understand that duty is imposed on goods, not a person. And as per section 21, floatsam, rec, jetsam are dutiable. So from whom this duty is collected? This is not dutiable, Naveen. They identify the transactions where the goods get carried on account of jetsam, floatsam. Naveen, if you recollect, there is one question which was asked by, I think you have asked this question. Even Namita raised this point. Sir, I have, say, 10 bags. I have thrown 2 bags, which is called jettism. After the boat has reached the coast, these 2 articles which are thrown were identified by, say, Namita. She says, sir, should I need to pay duty on 10 items or 8 items? So the question comes here is, the duty will be paid on the goods which have reached the coast. Since 8 goods have reached, we have said the duty will be paid on 8 goods. With respect to these 2 items, which have floatsam, they have came to the coast because of tide waters. This is deemed to be called as goods which have come to the coastal area and which will be put for an auction for the purpose of discarding. Like these floatsam, these goods will not be used by anyone, right? So those goods will be put it for auction, and whoever comes forward, they will take into consideration. So what we will do, students, we will start with our recap. As usual, we will take few questions from the previous session. We'll have a quick recap, and then we'll go for today's discussion. Hope Excel file is visible to all of you. And by the way, students, this material has been shared It has been hosted on Board of Studies ICAI website. You can download this particular material. Right? Okay. Now, we'll quickly have a recap on the basis of the previous session, which happened on 8th of February, and then we'll come with our today's class for discussion. Question number 1. Mrs. XYZ Limited have exported goods during June 2020 with payment of IGST for rupees 1.5 lakh to a customer in Japan. During December 2020, these goods have returned back by the customer. Examine the relevant customs provisions towards payments of duty payable in this regard. So this is a question where the goods have been exported by the exporter in June 2020. How did he make this export? Export under Rule 96 of IGST Act. So under Rule 1896, with payment of IGST. So this particular exporter has exported with payment of IGST. 1.5 lakh rupees has been paid in the month of June. And those goods have come back, that is returned. When I say return, it is a sales return. So the goods which I have exported, my own goods have come back in the month of December. So what have to be done? What has to be done? Please recollect the discussions in our last session and give the appropriate answer. What needs to be done in this regard? What needs to be done? The duty paid is rupees 1.5 lakh. I'll wait for a couple of answers and then we'll have a discussion on this. Examination, no need to quote any section number. You just need to explain the provision with the relevant reasoning. That is good enough. Quickly give your answers. So this entity XYZ Limited have claimed a refund of 150,000. The goods which have been exported in June 20 have come back in December 2020. Examination, please expect 4 marks from this question. Naveen says, yes, sir, amount is liable to duty under section 20. Okay. Amount of IGST claimed as refund has to be paid as duty as per section 20 re-importation at concession rate. It is not concession rate, Naveen. Concession rate is applicable when goods are used for a particular process of manufacture with the prior approval of the customs authority. Here, goods owned by, okay, there are two Naveens, by the way, Naveen Prakash and Naveen Kumar. Naveen Prakash says liable to duty under section 20. Naveen Prakash has given an answer. Amount of IGST claimed as per refund has to be paid as duty as per section 20, re-importation at concession rate. Okay. Now, I'll ask you to come to page number 1.12. Look at your page number 1.12. In page number 1.12, there is a table which is given concession in this regard, that is re-importation of goods under section 20. So here, the goods which have come back, okay. This particular concession, what you're referring, Naveen? Okay. So this, attention to page number 1.12, where the goods which have been exported under a particular provision, that is clause number 2, under claim for refund of integrated tax paid on export of goods. So continuation of this table to page number 1.13. What it says, the goods have been exported under a claim for refund of integrated tax paid on exports. So in that case, whatever at the time of place of importation, whatever amount of IGST and compensation compensation cess levy, that shall be paid back. Now, other availment of incentive. So here you will say that goods re-imported have to be taxed for the incentive availed at the time of export as per provisions of section 20 read with notification 45 of 2017. Now, so accordingly, Mrs. XYZ Limited has to pay back rupees 1.5 lakh at the time of during December 2020. So this would be answer with respect to question number 1. Naveen Prakash and Naveen Kumar, both of your answers are right. Yes, Naveen Prakash. Next, moving on to question number 2. Question number 2. Mr. A has imported a part for lathe machine from Singapore. Mr. A has imported a part for a lathe machine from Singapore. This product is covered under warranty for 3 years from the supplier. Value of the part imported is rupees 8,50,000. The above part has been sent. The above part has been sent for repairs outside the warranty period during September 2020. So what happened here? This particular A has sent this for repair out of the warranty period, means post-warranty. After the warranty is over, he has sent it for repair during September 2020. Manufacturer, out of the good relation with Mr. A, has not charged anything for the repairs. So this particular supplier, who happens to be from Singapore, has not charged anything for the service charges. Cost of insurance and freight borne by Mr. A amounts to rupees 76,000. Commercial invoice issued by the manufacturer indicate a notional cost of service for rupees $425. Examine the relevant provisions of customs duty for the compliance requirement by Mr. A. Customs rate notified for September 2020, $1 is worth rupees INR 78. So this is the question, students, where the goods which have been exported for the purpose of repair. This gentleman, Mr. A, has imported a part from a Singapore supplier. So this Singapore supplier has did a repair activity post warranty period. So the cost of warranty, which is shown in the commercial document, is $425, and the cost of transportation and insurance, which is borne by Mr. A, is rupees 76,000. So the question comes here: should A needs to pay any customs duty? Reason: A has not paid anything to the supplier. What supplier has done, whatever service he has done, he has given a notional service invoice only for the purpose of customs clearance, which carries $425. So is there any customs duty payable? Is there any customs duty applicable? If yes, how do we calculate? If yes, how do we calculate? You can mention customs duty payable, yes or no. If customs duty is payable, how this particular duty has to be calculated. Shivram mentions, so customs duty is payable on the value of repair alone. Okay. Why not on other charges, Shivram? Repair $425. Okay. So how do we compute calculate into INR? Have a look on that also, Shivram. Raman mentions that, sir, duty is not payable Okay. Let us see other answers also. Okay, good. Now, let me explain you this particular mechanism. Reference is drawn to re-import of goods after repair-related activity. Now, continuation to what we have discussed today. Look at your page number 1.13. Page number 1.13. Section 20, which talks about applicability of a duty, that is customs duty, on the value of re-imported goods after repairs. On what value? Fair cost of repairs, along with cost of materials used in the repair, along with freight and insurance, both freight and insurance include. Whether such costs are actually incurred or not, insurance and freight charges both ways. So here, your section 20, which talks about re-import, clearly explains that the goods, whether or not repair charges are paid, have to pay the particular customs duty. So here we will do this calculation this way. Cost of repair. My cost of repair, how do I calculate? I'll say $425 into the conversion rate given by customs notification is 78. My conversion rate is 78. $33,150 is my conversion cost of repair. Then Mr. A has spent rupees 76,000 on insurance and freight. Insurance and freight. 76,000. Total cost of repair along with insurance and freight. 1,09,150. So this is the value on which customs duty is payable. As per section 20, goods re-imported after repair shall be subjected to, I'll say customs duty, CD, customs duty on the notional value of repair along with consumables and insurance and freight, both the ways. So this is how I determine my value for the purpose of customs duty under section 20. 1,09,150 happens to be the value. Naveen Prakash says customs duty is payable on the notional service charge and cess leviable. Cess same shall be considered as value for IGST. Perfectly correct, Prakash. Naveen Kumar also has got the same reasoning. So basic customs duty, IGST cess cost material, whether actually incurred or not, insurance rate, both the ways. Perfect. I could see Naveen Prakash and Naveen Kumar, both of your answers are right now. Moving further, the last question for the day, question number 3. This is on the basis of section 15. Section 15, where we have discussed on look at your page number 1.23, section 15, date of determination of rate of duty and tariff value for imported goods. Now, question number 1. Examine the rate of customs duty applicable on the basis of below information. Point number for clause A. Goods are carried in a vessel which got entry permission on 15th July 2021. The rate of duty is 12%. Importer has filed bill of entry for home consumption on 20th July 2021, where rate of duty happens to be 18%. So in this case, we will apply the provisions of, come to page number 1.24. In case of goods entered for home consumption, date of presentation of bill of entry or date of entry inwards, whichever is later. So here, 15th July, the entry happened, 20th July, bill of entry has been filed. Later out of these two, 20th July. And which is the rate prevailing? 18%. So you'll mention that. as per provisions of section 15, whichever is later. I'll not mention these two conditions here. I'm just mentioning whichever is later, that is 18% applicable on the date of filing bill of entry. This is your answer. Next, question number 2. This question is based on your warehousing concept. Goods have been imported by mistakes, and these have been kept in a bonded warehouse after import. These goods have casted their entry through aircraft on 17 September 2021. At that point in time, the rate of duty is 18%. Bill of entry filed for home consumption on 30th October 2021, where the rate of duty happens to be nil. Now, for this, look at your point number 2, goods clear for home consumption. Date on which bill of entry for home consumption in respect of such goods is presented. So here, my date of filing bill of entry happens to be 30th October. On that date, my rate of duty happens to be nil. So we'll mention the rate applicable is as on 30th October 2021, that is nil. So this will be answer for section 15 in relation to goods which have been warehoused. Hope this discussion is clear, students. Yes, clear. 30th October 2021, which happens to be nil. Right. So this is a recap of our previous class discussion. Now, let us start with our today's discussion. Today's discussion, types of duty. And classification. Rules of classification. So next, we have another 2.5 hours roughly. We're going to have a discussion on this particular topic for next 2.5 hours, types of duty and rules of classification. Before that, students, in the last class, there's one small topic which I have left out. Let me quickly cover that particular last topic, and I'll come back to today's discussion. Hope the presentation is visible. Yeah. So in the last class, when we have started with our discussion, there are two topics with respect to exemption. One is this denaturing and mutilation. Second is exemption. These two topics are left out. I'll quickly cover these two topics and we'll come back to today's discussion on types of duties. So this particular section 24 talks about powers to make rules for denaturing or mutilation of goods. Now, what is this denaturing or what is this mutilation? It is a process where the goods will be diluted. The goods will be mixed with something else to make this goods fit for general purpose. The goods will be made for specific purpose. Like example, if there is alcohol for human consumption which is imported, this alcohol for human consumption can be sold in the open market. Rather, if the particular importer says, sir, I am a manufacturer, I do manufacture of this particular detergent products. For detergent products, I need to have some chemicals manufactured for which I need this particular alcohol. So that is a particular instance where the provisions of section 24 are applicable. Let's study this and then have an example on this. At the request of the owner, the denaturing or mutilation of imported goods which are ordinarily used for more than one purpose as to render them unfit for one or more such purpose. Now, this particular process, when we talk about mutilation or denaturing, this denaturing or mutilation is a process where the characteristics of the goods is restricted to a specific purpose. This is done using this power under section 24. So for this particular purpose, they have explained that it is done at the request of a importer consent. Where any goods are so denatured or mutilated, they shall be chargeable to duty at such rate which is applicable to those goods if these goods have been imported in the denatured or mutilated form. Like, sir, I have this aroma. Aroma is a kind of scent which is used in your deodorants. If a manufacturer of aroma imports a particular chemical, say for a moment, a particular chemical is imported, which can be used in food products, which can be used in cosmetics, which can also be used in industry, in general industry. Aroma can be used for various categories. So what if this aroma which is used in cosmetics is taxable at the rate of 28%? The aroma which is used in food products is taxed at the rate of 12%. Now, this importer wants to get a specific exemption of, he wants to pay specific duty of 12%. For example, sir, I manufacture laddu. When I manufacture laddu, I want to give a taste of natural Goa. I want to give a natural taste of jamun or natural taste of grapes. This particular taste comes along with this aroma. So that is a particular case where this process of denaturing has to be applied. So what happens here? The applicant, whoever is an importer, he goes to the customs officer and says, "Sir, I have imported these goods for this particular specific purpose. Now, as I say, my aroma I can use in cosmetics. This aroma I can use in detergent powders. I can also use in food products. If I use it for food products, I have to make it unusable for cosmetics or detergents. So for that, this is a process called denaturing. So once the officer denatures or does the mutilation, what is that? A chemical will be added, a composition will be added, so that you make this particular composition fit for that use only. In any way, you don't have a revert back of a chemical or revert back to the original condition. So this is a process called denaturing or mutilation. Now, the central government has got an authority to make rules in this regard. As of today, denaturing spirit rules have been formulated where ethyl alcohol, which is not denatured. The moment I say ethyl alcohol, this is for human consumption, which is not denatured, attracts a higher rate of customs duty. Whereas denatured ethyl alcohol attracts a lower rate of duty. Now, this ethyl alcohol, it can be used for human consumption. It can be used for industrial purpose. Sir, if I use for human consumption, the rate of tax is 28% to 40%. But the same ethyl alcohol, if I use it for my industrial purpose, the rate of tax is 12%. So here what happens? In case of ethyl alcohol, which can be consumed by the human beings, instead of happening so, they do a process called denaturing. So once I add a particular chemical, it is very tough to take it back. So this is a process involved where even customs authorities have a knowledge of how a particular product works, what activity needs to be done to ensure that it doesn't restore back to its original form. I would draw your attention to, I don't know how many of you have seen in movies. In South India, there's one movie where in customs authorities, customs process, they show a particular item, which is like white, which is what you call, there's a photo frame. A particular manufacturer packs something as a photo frame. These photo frames are exported out of India. Now, when the customs authorities open, say assuming that this is a photo frame, just a photo frame where I can keep my photo. This particular photo frame, when it is immersed in a particular chemical, the exterior parts, it changes its color and the originality comes out of it, which is as good as a precious metal. So at times, they, to protect the customs duty, either for import purpose or export purpose, the components will be added with few chemicals to change the customs duty applicable. So customs authorities also have a decent knowledge on what kind of product, how it is used, what is the usage of the industry. So this is one process where application of denaturing, a honest importer goes to the customs authorities and says, my dear officer, I don't want to use it for human consumption. I want to use it for industrial purpose. So kindly do the process of denaturing at your end and release the goods. Once the denaturing is done in customs premises, in their in front of their presence, then whatever is the duty applicable for those products, that shall prevail. This is the purpose of your denaturing or mutilation. Next. Exemption under customs duty. Now, this particular exemption even applicable for GST laws also. Section 11 of CGST Act deals with the power to grant exemption. So in this particular case of exemption, there is a purpose why exemptions are given under any law, either income tax, either GST law or your customs law. Whenever there is an exemption notification given, that exemption notification can be of two sorts. One is a general exemption, second is a special exemption. When I say general, it is in general, but it is not catering to a particular industry or particular sector. So this particular general exemption, in general, it will be given where it is an absolute exemption or conditional. Now, when I say absolute exemption, there are no conditions. Any goods imported in relation to stainless steel, classifiable under, say, Chapter 37, they say the rate of duty from existing 18% will be applicable for 12%. So it is an absolute, which is having no conditions, or conditional. When I say conditions, they will impose conditions like, no, you should be importing from this date to this date. This material should have been imported from so-and-so nation. This particular material should be imported for specific purpose. So when exemption notification is given, it could be either absolute exemption or a conditional exemption. So when you say absolute exemption, take example. You have your, LIC. Under income tax, when I claim contribution to PPF or LIC or children education, that is your tuition fees, ATC gives me a general exemption, which is absolute exemption, no conditions. Or conditional exemption. What is a conditional exemption? I could have an exemption saying that so much of capital gains should have been invested in so and so, or this capital gains should have been invested for reconstruction. There is a condition attached to that. So my exemption notification always gives a guidance whether it is an absolute exemption or a conditional. Now, special exemption. So why do I give a special exemption? When there is an emergency, when there is a need, when there is an exigency, I give a special order for giving an exemption to an exceptional nature to be stated in that order. COVID is a classic example. When COVID has taken, when Minister of Health has declared that this is pandemic, during COVID, there are many medicines where a special exemption notification was given saying that so-and-so machinery imported for so-and-so sector, there's an exemption notification. Example, your PPE kits, manufacturing of your oxygen, or setting up a plant, your power generating units, power backup units. There are a set of industries where government felt on an immediate basis, we have to give exemption for the imports. So all those imports which happen during a particular period, I could have a special exemption. That means by a special order. Now, this particular exemption can be classified on the basis of nature of this existence. Moving on further. Whenever there is a exemption given, to clarify the scope or applicability, an explanation will be inserted. I don't know how many of you have read the BEAR Act. See, you're going to get qualified 2 years, another 6 to 9 months down the line. Once you get into practice, once you get into industry, I would recommend start reading the BEAR Act. could be company law, could be GST law, could be income tax. Whenever you read a section, there is a reference to something called explanation. This explanation is always inserted in a statute for what? For giving a scope, for giving a clarity on what is the scope or what is its applicability. If you remember section 10 under GST law, section 10, which deals with your composition scheme. Under composition scheme, there was one question raised when the GST law was brought in. Sir, you have said that the turnover of 75 lakhs was mentioned. Up to 75 lakhs, I can get into composition. You said that the activity of service should not be undertaken by the registered person concerned. There was a question raised. So what if there is a bank deposit on which I draw interest? Interest on bank deposit was clarified as exempted notification, exempted service. So there was no clarity. Immediately, government felt that there should be a clarification provided where they have inserted an explanation. So what happens whenever an explanation is inserted, it gives a clarity on the scope or applicability. This is the purpose. And generally, the time limit for insertion is 1 year from to issue, within 1 year of issue of the notification. Whenever there is a particular amendment, within 1 year of that particular act enacted, they have to insert this explanation. So statutorily, 1 year is the time to insert an explanation in any statutory provision. And once this explanation has been inserted, it is deemed that as if it has been inserted the day the notification or the order has come into existence. Assuming for a moment, on 10th April 2020, 10th April 2020, now there is COVID was declared on my 20th April. So 21st April, assuming that 20th April 2020, there was one exemption notification. This exemption notification says that all products which are used for pharmaceutical industry shall continue to enjoy exemption from customs duty from 18% to 12%. See, this is given in relation to pharmaceutical industry. For a moment, this notification has to be enjoyed by a pharmaceutical industry for importing of a machinery, importing of a particular device which is used for manufacture. Now, raw materials, everyone knows that any raw material imported can enjoy the exemption of 12%, that is 6%. Instead of paying 18%, 12% have to be paid, 6% can be enjoyed. So what if capital goods are imported? My notification doesn't say that this is applicable for capital goods. It is applicable only for raw materials is a general understanding. This particular aspect can be clarified by way of an explanation. And they say that within 1 year, explanation has to be inserted. So when an explanation is inserted saying that even capital goods are included for the above entry, that is good enough to take care all the litigations which are bound to happen in relation to this exemption notification. Now, common understanding. So whenever an exemption notification has been issued, it will come into effect the day it has been issued. My exemption notification will come into existence the day it has been notified, until and unless it is provided that it has to be notified at a later point in time. These days we have Facebook, Twitter, your WhatsApp, where today if the revenue secretary signs a notification, instantly within few minutes this notification gets uploaded to social media. Imagine 10 years back, imagine 15 years back, imagine 25 years back. When a particular notification has been gazetted, it gets approval from the Finance Ministry North Block in Delhi. From Delhi, that particular notification, say it has to be reached to Chennai, it has to reach to Kerala, where there is an import which is happening. Now, those days we had only radio or television. Now, no one has so much of knowledge that whatever announcements was made will get notified to the end of the other part of India. So, considering those practical reasons, generally they say that whenever an exemption notification is issued, the day it has been issued, it shall have power. If required, they will mention that this notification is valid from 5 days down the line. So this is the purpose of my granting a exemption notification. Now, petty things I'll just skip now for want of time. Yeah. Now, this one last slide, examination, you can expect 4 marks question. Examine the powers of providing exemption under customs laws, where you will refer to general exemption, specific exemption. Also, you will clarify in the process of this how an exemption notification will be valid from the how it is going to be effective. You'll also refer to insertion of an explanation to remove difficulties in implementation of exemption notification. Whenever an exemption notification is given, it is given under the control of a parliament, that is upper house, lower house. They generally give a permission to give an exemption notification. So why is exemption notification required? Where goods have not reached Indian soil at all. Sir, I have filed bill of entry. This particular ship, it has got a permission to the Indian territorial waters. The moment news has come, I deposited customs duty. Some reason there was a wreck, there was a breakage of the ship. All particular goods have been jettisoned and none of those goods have come into Indian soil. Then by virtue of section 25, granting of exemption notification, whatever duty have to be paid, that will be exempted on that particular consignment. Or the goods have reached Indian soil but are not available for consumption. So why? There is a damage, there is a fire accident. Example, a tsunami has occurred or a fire accident has occurred. The goods have been imported. In the process of importing, there was a small fire accident and entire goods were burnt. Now, when the goods are not made available, it have reached the Indian soil, but it was not available to the importer. Again, by virtue of section 25, this exemption notification can be issued. Moving further. Now, this is an important point. Issuing a exemption notification is a discretionary provision, where exemption is used for controlling the economy and also industrial growth of the country. Now, no one can challenge an exemption notification in the High Court or the Supreme Court. Reason, courts generally doesn't intervene in policy matters. Whenever a policy matter has to be decided, courts say that, look, this is a matter of policy which is decided by Parliament. Parliament has got a capacity to take decision good for the interest of the nation. Like example, there was one writ petition filed in the state of Gujarat where one of the association asked, sir, we have been into the activity of manufacturing of ice cream. We were not permitted to get into composition scheme. Though we have a turnover less than 1.5 crore, the GST doesn't permit us to get into composition scheme. The Gujarat High Court straight away said, look, this is a matter of policy. We will at best recommend the GST Council to take a decision on this. So the similar way in relation to exemption notification, this section 25 clearly says that, look, the government, that is central government, has got a clear authority why to give an exemption, when to give an exemption. Many of you would have heard Article 14 of Constitution, right to freedom, like freedom of speech, freedom, various rights which have been given under Article 14, right to do business. Now, majority of the businessmen knock at the door of Article 226, filing a writ petition saying that my natural rights have been violated. This section 25 overrides that, saying that, look, these notifications are part and parcel of the enactment, and it cannot be challenged by imposing Article 14. Like one example, let's take. See, Naveen Prakash is into manufacture of rubber tires. Priya Agarwal is into manufacture of, say, what I can say, some machinery products where rubber is a component of the machinery products. Naveen Prakash predominantly uses the imported rubber for a specific activity called tiles or tubes manufacturing. The same rubber imported by, say, Priya Agarwal, she uses this for some machinery manufacturing process. Now, assuming that government gives the exemption notification, the natural rubber imported enjoys a concession rate instead of 28%, it enjoys 12%. Only in relation to manufacture of rubber products. Now, Priya Agarwal can challenge this particular notification saying that, look, Naveen is importing natural rubber, Priya Agarwal is also importing natural rubber. She cannot challenge this notification in the High Court or a Supreme Court saying that, why is that the government is discretionary to say that this is to be given only to that industry, not to this industry? This principles of Article 14, that is your business, violation of your business principles cannot be challenged. The time-bound notifications can be withdrawn. Supervening public equity or interest overrides promissory estoppel. Now, this is what I was referring on day one. Any notification which has been issued can be withdrawn in the public interest, and no one can challenge promissory estoppel. What is a promissory estoppel? As per the Contract Act, there is a binding activity by one person to another person. Assuming the government of India has come with a notification saying that from 1st August 2021 till 31st August 2021, any cartridges which are imported will be enjoying a notification exemption. Instead of 40%, the rate of tax is 18%. The particular August, cartridges which are imported, they have notified that instead of 40, it should be 18%. So 15th August, I have imported the goods. When I filed for a bill of entry, suddenly on 15th midnight, government has withdrawn that exemption notification. Now, I, as a trader, cannot go and challenge in High Court, saying that, sir, I have imported the material, looking that there is an exemption notification. Government has withdrawn that exemption notification. No, government says, look, in the interest of public, I have a full freedom to impose an exemption or to withdraw an exemption. This principle of promissory estoppel cannot be challenged. They say that, look, government has not promised you that you have to pay customs duty at so and so rate, and I'll give you exemption at this particular rate. Government has a liberty to give, government has a liberty to withdraw. So why is that done? In the public interest. Connection of this, there is something called anti-dumping duty or countervailing duty. In today's discussion, you'll understand the beautiness of this exemption notifications with the challenges the customs authorities face through. These are based on certain Supreme Court decisions. Let me come to today's topic for discussion called various duties under customs along with classification. So let's start with our today's discussion. Today, we will understand the various duties which are applicable under customs law and also taxes on the imports or exports. And by the way, there is a provision which is connected with valuation where we do some mathematics of calculation of customs duty. Today's class, we will spend in terms of understanding the duties applicable. Examination, expect one question for 4 marks from today's class called various duties under customs law. There's one topic which I'm going to touch upon with respect to safeguard duty and exemption. There are two topics, section 8, 8A, 8B, section 9A. One question from these 4 topics is expected considering the way the notifications have been issued under these notifications. When I come to the respective slide, I'll give you importance on this, but wait and watch for these notifications why a duty at all is levied and in what scenario those duties are levied. So we'll understand what set of duties are there, how it will be levied, and what is the specific purpose of that particular duty. And when government proposes to levy a duty, is there a right or is there a remedy available to the importer to challenge that particular duty at all? And finally, we will read through some of the classification rules for understanding how the goods can be classified when import takes place. Now, as we understood in the last session, we have read a definition called assessment. In the definition called assessment, I have opened up this discussion called levy of duty under section 12. So whenever we read section 12, there are three more sections called 13, 21, 22. With respect to your petty theft, with respect to damage, with respect to your loss or defects, destroying. These three provisions, 13, 21, 22, pilferage, your damage, loss, damage, and abatement. These three have to be read together. So whenever we talk about customs duty, my customs duty is governed by section 12 of Customs Act. And the rate, how much is the rate applicable? It is given in my Customs Tariff Act 1975. So here, first and foremost, I look at my Customs Act. Sir, is this goods dutiable? Are these goods dutiable? Naveen Prakash or Naveen, you have raised this question mark. You are referring to section 21, saying that, sir, when there is a float SAM, why duty is applicable? When there is a float SAM, duty is not applicable, ma'am. Float SAM clearly says that these are the instances where the goods are duty free. Look at your page number 1.18, Naveen Prakash. In case of section 21, officer, like the last line, to the satisfaction of the officer that they are entitled to be admitted duty free under this act. Why? It is a float SAM. So section 21 clarifies whether there is a duty applicable. If answer is yes, duty is applicable, then I refer to Customs Tariff Act, section 2. My Customs Tariff Act has got two schedules. Schedule number 1, which is called first schedule, which is applicable on import of goods. So there are various rates given for import of goods. Schedule number 2, which prescribes the rate of duty for exports. So students, just keep in mind, whenever we talk about customs duty, this customs duty is payable both on imports and exports. Now, imports, majority goods are subjected. Exports, only few goods have been notified. At the some point in time, I'll take you through first schedule. I'll also take you through second schedule to understand why government is levying duty and what is the intention behind levying a duty on the goods imported or exported. So prima facie, for you to understand, please keep in mind section 2 of Customs Tariff Act. Section 2 of Customs Tariff Act has got two schedules. That is schedule number 1, which deals with your imports. Schedule number 2, which deals with your exports. Before I go further, let me see if there are any doubts so far. Good. So far so good, no doubts. Now, before we start with countervailing duty, I'll explain the backdrop of this particular duty. Relevance of HSN, Harmonized System of Nomenclature. This World Trade Organization is an entity where association of countries have become members in World Trade Organization. Why? To regulate the trade policies, to frame, to govern, to put forth all the issues and to get a solution for the particular trade concerns on the international trade concern. This World Trade Organization read with World Trade Customs. These are the two organizations which help a particular member country to decide how this particular nomenclature has to be done. I give an example. This is a pen which is used for writing purpose. Now, this pen, when I travel to Germany, I may not call as pen, I may call something else. The same pen, when I go to Japan, I may call something else. When I go to Korea, I may call something else. When I go to Iraq, I may call something else. So this particular commodity, to have a universal language, the universal language is represented by this term called HSN, Harmonized System of Nomenclature. And this HSN has to be in line with the HSN formulated by WTO, World Trade Organization. So any nation where I import the goods, when I export the goods have to be represented using HSN. Simple example, Germany. When I import goods from Germany, the commercial invoice is printed not in English, it is in German language. When I import goods from Japan, some portion of language is visible in English, the rest all is in Japanese language. The only language which is uniform is your HSN. So when I export a pen, referring to this as classifiable under 38. Now, the moment the goods enter the customs port, the concerned officer looks at 38. Under that subchapter 12, he says, oh, the goods which have been imported are stationary. Now, this is how the nomenclature helps in case of your international trade. And in India, we have adopted the customs, World Customs Organization HSN for the purpose of classification. Global level, the HSN is at 6-digit level. But in India, my Customs Tariff Act has been, nomenclature has been given to 8-digit level. Now, this is the reason why most of my GST provisions mentions that any tax invoice issued should have my HSN at 6-digit level. Assessees having an aggregate turnover exceeding 5 crore, it is mandatory to quote 6-digit, and less than 5 crore, it is mandatory to quote 4-digit HSN. So why do we have 6-digit? Why not have 8-digit? GST law. Reason: my World Customs Organization as a uniform practice across the globe, wherever I go, 6-digit HSN is mandatory. However, in Indian Customs Tariff Act, we went one step further to have 8-digit level classification. Now, when I look into my HSN, that is schedule, first schedule, in case of imports, I have 5 headings. First heading called tariff item. This is what I call my classification of HSN. My HSN is mentioned in my first item or tariff item. Based on HSN, I will say, is it a particular electronic goods? Is it rubber product? Is it a food products? Is it meat or agriculture produce? I determine, I ascertain on the basis of HSN. HSN alone will not help me. For that reason, I have added something called description. So when I look into my your first schedule, I have a tariff. For this tariff, there is a description. And this particular description, I have something called UOM, unit of measurement. This UOM indicates kg or liters or millimeter, length, mass, volume. Now, I have various commodities measured in various aspects. So this particular tariff, where there's a description, I'll say, how do I measure this? For this particular unit of measurement, there is something called rate of duty, where a standard rate is there, preferential rate is there. My rate of duty is generally adopted by for standard rate. I'll come to this aspect of preferential rate. Time being, skip this particular item. But whenever I look into first schedule, these are the 5 headings I can see. So why do I have this particular rate chart? Whenever we import the goods, for your basic understanding purpose, say your sales and marketing fellow comes to the CEO or CFO and says, sir, we are importing a consignment where this particular commodity what you are exporting is a dairy. This is a book which is called dairy. What is the specific purpose of this dairy? So this is a dairy where we have all our catalog items printed, where this has got all your the product description with your functionality. Now, this is a dairy which is used for marketing my products. Now, this I can call as a brochure for marketing purpose. So what I will do, first and foremost, I look what is the tariff item they have given, and on that basis, what is the description? What is the basis? Is it number? Is it pieces? Is it kg? And what is the rate of duty applicable? Generally, my rate of duty is standard rate. Only in exceptional cases, I go for preferential rate of duty. So this is a basic understanding with respect to my relevance of HSN. Now, from here starts the various duties which are available under customs law. Before I start with this explanation, I'll give you a backdrop for you to understand the importance of the duties which have been classified, the duties which have been brought under the customs law. It is very, very important for the customs officer to understand the nature of business. I would say, lot of patience, lot of knowledge, lot of experience, lot of exposure. I use the term lot just to signify the importance. There should be a patience, there should be experience, there should be exposure, and there should be also knowledge of the industry. Reason. You would have seen in many movies, where whenever a smuggling happens, the customs officer has a prior information, or customs officer has a knowledge of finding out a person who is a culprit, or a person who's been into the activity of smuggling. How? By experience. A person who walks casually, a person who walks with a fear of mind, who's watching me, who's observing me, there's some sort of fairness which can be identified. So these people have various aspects to be dealt with. Similarly, when it comes to the customs law, they have to understand the overall industry. Like example, so when we are studying our CA curriculum, our main exposure is into costing, financial accounting, taxation, could be direct tax, indirect tax. Finally, towards my consolidation of financial statements, presentation of financial statements. And precisely, main pillar is auditing. Now, this is the fulcrum within which we look at the industry. From customs point of view, they have a 360 degrees variation to understand what kind of product, to say what kind of duty has to be imposed to protect the interest of the economy. Now, all of a sudden, there is an import of LED TVs. All of a sudden, there is import of laptops. Now, customs cannot keep quiet. Customs have to regulate the trade. There is something called goods which are getting dumped into India. Anti-dumping duty should be imposed. There is something called goods which have been imported to make the goods dead cheap compared to the local products available. Example, your solar instruments. You see this small toys which are meant for kids playing purpose. Any mall you visit, these toys are predominantly imported from China. Why is that we don't have goods in India? Why is that the manufacturing doesn't happen in India? It do happens, but the dumping from China is so high that it can replace the Indian manufacturer. Now take an instance, a small projector, like I have an LED pen. When I have this pen to be projected, this is also made in China. Now, government has to visualize the industry, government has to look at the products, and they have to regulate the goods which are coming into India, right? So this is how the various duties play a role for each of those goods which come into entry into India. Starting with preferential rate of duty. Preferential rate of duty is a mechanism where there's a reduction, there's a lower rate of duty applicable. So generally, the standard rate of basic customs duty is applicable when you look at your previous slide, entry number 4, entry number 5. Entry number 4 is called your general duty. By and large, entry number 4 is the duty which I call as a basic customs duty. There is something called preferential rate of duty. Why is it applicable? This preferential rate of duty is applicable where the goods are imported from areas which are notified by central government, which is to be identified as a preferential area, where my lower preferential rate of basic customs duty is applicable. Example, Myanmar or Taiwan. At times, there will be a treaty between one nation to another nation. Say for a moment, for an instance, my external minister of my Minister of Revenue or External Affairs Minister exchange a dialogue with the Myanmar nation, saying that, look, we will encourage you for this particular industry. In turn, please encourage for this particular thing. There's a bilateral agreement. There, this preferential rate of duty comes into picture, where government, that is central government, will specify, saying that these are preferential areas. This is to be notified. Means government is going to specify that any goods which are imported from these nations or these areas will be of a preferential rate. Means my rate of duty is lesser. So why do I do that? then other nation should develop, I also get developed. I support that nation supports to me. Now, if you recollect, like COVID, when there was a disturbance between the border, India and China. Now, the good thing, whatever Honorable Prime Minister have done, he started exchanging dialogue with the other associated nations, where this kind of bilateral treaty was brought in to encourage the other industries. Unfortunately, this tough tug of war between India and Pakistan, India and China, that continues. We don't see an end to that. But government do get into this mechanism of bilateral treaty to notify the preferential rate of duty. So to impose the preferential rate of duty, any person who is importing that particular goods, what he has to do, whenever he is importing, he has to make a reference. So he has to notify to the customs officer, my dear officer, the regular rate is 18%, preferential rate is 12%. Please classify 12% for the reason this is being imported from so-and-so nation. Important aspect. Goods manufactured or produced in such preferential area. Now, this becomes a challenge. See, unfortunately, the laws made by Indian government are very good. But when it comes to implementation, when it comes to execution, there are challenges. Now, for a moment, Government of India says any textile product which is imported from Myanmar is having a preferential rate. Now, for a moment, this in news, the moment there is a bilateral treaty, the citizen of India, the citizen of Myanmar gets to know. For a moment, let's assume that there is a trader in Myanmar who has got a connects in China. So this particular person, what he does, that trader imports material to Myanmar from China. He just does the packing. When he removes the exterior packing, he puts his packing and exports from Myanmar to India. Now, what is happening here? Goods are actually not manufactured in Myanmar. It is manufactured in some other territory. From that territory, it is coming to Myanmar, and from Myanmar, it is coming to India. Isn't it a challenge for the customs officer to look into this thing? So here they say that only those goods which are manufactured or produced in such preferential area shall enjoy this preferential rate of duty. Now, this becomes a challenge for the customs officer. Origin of goods shall be determined in accordance with the rules made thereunder. Now, for this particular purpose, generally what they do, like we have this Make in India principle. Goods which are manufactured in India, there is a seal called Make in India. The customs officer and other officer, they take samples, they ensure that there is a existence of a setup to manufacture so-and-so commodities. So to encourage this bilateral treaty, even the customs officer in India ensure that the goods which are originating from India, having this brand called Make in India. Similarly, the offices in the other nation, when the goods are getting exported from so-and-so nation, they also ensure that the goods are made for this particular preferential rate of duty to ensure that these goods have been originated from that particular soil where the manufacture or production happens. So these are a couple of conditions in relation to my preferential rate of duty. Now, moving on. Levy of additional duty. Section 3, which is a competitive section, which is a section frame considering the Indian economy. I'll give you a brief understanding why this particular concept was brought in, and then we'll move to the respective slides. Prior to GST, like 2017, where we have seen GST which came into existence, and after GST, it is not that central excise was completely removed. Even till today, there is a levy of central excise duty, there is a levy of sales tax on some of the products. The state excise is also applicable. So this concept of additional duty, levy of additional duty under Section 3, this was brought in to make a level playing field. I'll give this example. Say there is a running competition. When there's a running competition, 300 meters, 500 meters. A student who is studying 5th standard, a student who is studying 10th standard, there's a capacity for a 5th standard student, 10th standard student. So I have to compare a student who has run 300 meters, a student who has run 500 meters on the basis of their capacity to run that particular race. The same way, my lawmaker has to make a level playing platform to ensure that goods which are manufactured in India, goods which are imported into India have a level playing field. So the one hand, I have a manufacturer in India. On the other hand, I have an importer. Now it comes very important. Should the government encourage the manufacturing in India? Should the government encourage the trader who imports the goods into India? Now, this is a kind of $1 million question. There is a supply, there is a demand which has to be met. So on the basis of demand and supply, this gentleman works, this gentleman works. Now, prima facie, government has to encourage this particular trader, this particular businessman who does a manufacturing activity in India. Why? Whenever there is a manufacturing activity happens, there is a setup of plant. When there is a plant setup, employment opportunities get created. And this particular manufacturer procures domestically where there are ancillary units which gets established. Now, these are the various benefits which are available in case of a manufacturer. So what happened here? This section 3 was brought in to ensure that, look, I will see there is a manufacturing activity in India. To compensate the goods which are imported, whatever excess duty is applicable in India, let me impose the equivalent duty on goods which have been imported. So what if there is no manufacturing activity? Good. Those goods which have been imported, assuming that it is not manufactured. So what I will do, I'll skip that. I'll see if there is any other hit to the industry in India. Second issue came. Sir, I am not a manufacturer of this particular product. However, there are raw material which have been imported. This raw material are manufactured in India. The same raw material can also be imported from other nation. Example. You have this steel rods, ignots, and you have this cut ends, steel ends. The steel products which have been imported, can be manufactured in India. If I have to do manufacture, there is the availability of natural resource, manpower, and also various other particular business conditions which prevail for that raw material to be manufactured. For a moment, I'm a manufacturer of TVS motors. TVS motors needs steel and iron for the chassis to manufacture. Now, this chassis, if I have to manufacture, I need steel and iron. They have a choice to go to Steel Authority of India to buy the steel. They have a choice, instead of buying from Steel Authority of India, SAIL, they can import from metal steels. So when I import from metal steels, so per ton, it costs me 70,000. The same steel, if I procure locally, it may cost me 95,000. So why there is a variation? 95,000 is the cost in India. 70,000 happens to be a cost if I have to import. Now government felt, look, there's a gap of some 15 to 20,000. Now this gap, if I don't fill up, it so happens that my local manufacturer is going to lose his entire survival. So let me make a level playing field by imposing an additional duty. This is the second reason. First, in case if there is a manufacturing of that product. Second, in case of manufacture of raw materials. Third, in case if the goods are not manufactured, if the goods are not a raw material in nature, if the goods are traded commodities. Sir, I have goods which are traded in India, the goods which are imported into India. The goods which are traded in India attracts VAT and sales tax. The goods which are imported in India does not attract sales tax. So these are the three principles where this particular additional duty was thought of. As of today, the levy of excise duty, that is central excise, state excise, or sales tax. These three provisions have been reduced drastically. Rather, GST, that is Section 3, subsection 8, we will discuss in a short while, which talks about levy of additional duty to compensate GST paid in India. So this is a backdrop why additional duty was brought in under customs law. Moving on, additional duty. Now, alcoholic liquor for human consumption. Officers who are governed with levy of duty on this alcoholic liquor is the state excise authorities. Generally, out of the context I'm talking, the state excise officers are the most powerful officers in any state concern. For the simple reason, getting a license of alcoholic liquor is worth crores of rupees in any state. Getting an alcoholic liquor is so costly, it is not that possible. And only the elected members of the parliament happens to be the binamis or happens to be the people who hold this liquor license. And as of today, the authority to levy tax or duty is on the state, respective state or union territories. This alcoholic liquor is not under the purview of central jurisdiction. It is under purview of state jurisdiction. So any alcoholic liquor which is imported into India, maybe for human consumption or otherwise, this is not governed by the central government. However, additional duty is levied adopting the rate which is prevailing in a respective state. So whenever there is a state which sells alcoholic liquor, the rate in that state will be considered for the purpose of my additional duty to compensate, to make a level playing field. Not much to discuss on alcoholic liquor. Now, manufacture. As I've said, like to start with, section 3, subsection 3 talks about this levy of excise duty, the levy of additional duty, which is to replace my excise duty on raw materials. So this section 3, subsection 3 talks about a case where raw materials are imported for the purpose of manufacturing activity. As of today, only GST is applicable. This section 3, subsection 3 has lost its charm. Only the products where we can see this subsection 3 is in relation to petroleum products. Why? Petroleum products are still under the purview of central excise. There is a levy of central excise. Only for those products, my applicability of additional duty under section 3, subsection 3 gets applied. Now, this section 3, subsection 5, which is 1 point in 10 called as special additional duty, SAD, special additional duty. This special additional duty is levied to compensate sales tax, VAT or local tax or any other charges which is applicable in case of a commodity which is bought and sold in India. As of today, since this VAT has been subsumed, but still applicability of sales tax continues, but some of the tobacco items, some of the commodities, section 3.5 holds good even as of today. Important aspect, section 3, subsection 7, levy of IGST. Now, this is a commodity where we see as of today that any goods which are imported into India, additional duty is applicable under what? Under 3, subsection 7. What do they say? Look, goods which have been imported into India, there is a levy of basic customs duty. In addition to basic customs duty, I levy under 3.7, that is called IGST. I levy something called IGST. Why? Because these goods which have been brought into India are subjected to local taxes. Whatever local tax is applicable, I refer to notification 1 of 2017 for rate of tax. I look into 2 of 2017 to see whether there is any exemption. If the goods which are imported into India are taxable under 1 of 2017, so in addition to basic customs duty, I pay IGST. So what if the goods are exempted? Example, agriculture produce. Because agriculture produce is exempted under 2 of 2017, I pay only basic customs duty and I don't pay IGST. So this is a mechanism where my additional duty by virtue of 3 subsection 7 talks about levy of a IGST. So why IGST is required? Because the goods which are imported into India needs to pay IGST, which is paid locally. I levy this particular duty. Now, how is this particular IGST calculated? I'll just come to my Excel file, then we'll discuss on this particular model. My section 3, subsection A talks about the mechanism for levy of IGST. Now, it says that value of goods, this is determined as per section 14. Then basic customs duty on above goods. Then social welfare surcharge applicable at the rate of 10%. Since 2018, there is a levy called social welfare surcharge, which is levied on basic customs duty. Value for IGST. So what I will do, what is the basic value for your customs purpose? On that, what is the customs duty payable? On that social welfare charge of 10%, that total value becomes, this total value becomes my value for IGST, right? So they say that you take the value, on that apply the basic customs duty, also apply social welfare surcharge. This social welfare surcharge is applied on basic customs duty. And if I add all these three, the value what I get, this is the value on which I have to pay my IGST. Let's take an example. So value of goods imported as per section 14 is 10,25,000. Assuming that 10,25,000 is the value of goods. On that, assuming customs rate notified is 18% and social welfare surcharge is 10%. So what we will do? I calculate on this basic value 18%. This happens to be my basic customs duty. This I call BCD. On BCD, 10% is my social welfare surcharge. If I add all these three components, what I get is the assessable value for the purpose of levy of IGST, right? So assessable value for levy of IGST under section 3, subsection 7. This we call as an additional duty. Now, assuming for a moment that the goods are taxable at the rate of 18% in India. So what I will do, I'll calculate on this value 18% IGST. So this is a mechanism how I calculate my IGST. Are we clear, students? Calculation of the value as per section 14, value of goods as per section 14. On that, the basic customs duty. On that, 10% of social welfare surcharge. All these three put together, I think 10 lakh, this one X is 0. Yeah, 10,25,000. On that, 1,84,500 happens to be 18% basic customs duty. And 18,450 happens to be my social welfare surcharge. All put together, 12,27,000 happens to be my value. On that, 18% is what I'm going to apply. Let me come back to my presentation. So they say aggregate value of goods as per 14 of Customs Act. This section 14, very, very important. Examination. Question is set for 6 marks, 4 to 6 marks under section 14. The forthcoming session, 12, we are going to discuss on section 14, how valuation is determined under Customs Act. Very important. On that particular value, what I will do, I levy something called customs duty. On this customs duty, whatever social welfare surcharge is there, that will be applied. And similarly, compensation cess. Whatever value I have done for IGST, same thing I'll do for my compensation cess. To give a backdrop, there is something called compensation cess. So what is a compensation cess? When GST was brought in, various states have discussion. Look, I'm going to lose on account of revenue when I have to migrate from local tax regime to GST. So to compensate the states, there was a levy of cess, which was brought under cess, levy of Goods and Services Tax Cess Act 2017. So as per this act, a cess is applicable, cess is leviable under section 8. So there is a mechanism called GST compensation cess under section 8. And these goods there are specific goods which are notified. As on today, if you see this section 8, my soft drinks, my tobacco products, motor vehicles, and some portion of coal which is used for power generation. These are the goods which have been notified as of today for the purpose of levy of cess. I don't know how many of you have observed, you buy a cool drink, maybe this what you call aerated water, your what you call Pepsi or Coke, which has got a component of this aerated water. There is a cess of 12% applicable. Similarly, all tobacco products, your BD, wrapper, cigarettes, various components of tobacco products, there is a cess applicable. Motor vehicles, value exceeding 10 lakh rupees. When I buy a four-wheeler exceeding rupees 10 lakh, I pay something called cess. So based on this classification, cess is applicable as on today. So for the purpose of customs law, any of these goods imported, to make a level playing field, my additional duty is applicable to compensate this cess, which is applicable under Section 3, subsection 9. (8)(a). Now, sir, what if there are goods which are warehoused? I have imported these goods, I have kept it in my warehouse. I have not cleared bonded warehouse. I have not cleared the material. Now, this is a concept I was talking some time back, where I use this warehouse as a concept for the purpose of trading activity. I don't pay customs duty, I just keep in the warehouse and I transfer the title to these goods. So those goods which are kept in a bonded warehouse, there is the applicability of IGST, that is value as per my Section 8 or the transaction value will be considered for the purpose of levy of customs duty. What they do, whenever goods are cleared from bonded warehouse, you take the value of those goods imported, the day when you imported. Value on the date of import. Or the transaction value. I'll give an example to have a better understanding. Now, say 13th July 2021. Then 25th August 2021. Then 30th September 2021. Person, value. So the goods are imported by initially Naveen on 13th July 2021. So the value of goods is rupees 1,25,000. This is the value of goods which were imported by Naveen. Now, Naveen has kept these goods in a bonded warehouse. What he has done, he has transferred the title to the goods to, say, Priya on 25th August 2021. These goods which have reached, those goods are still in bonded warehouse, and Naveen has sold these goods with a margin of 20%. 20% margin. The value of goods has become 15 lakhs. After some point in time, Priya has sold these goods to, say, Namita. Priya has kept a margin of, say, 1.15. 15% she has kept a margin. Finally, this is reached to the hands of Namita for 17,25,000. Now the question comes here. GST. When Naveen has sold the goods to Priya, Naveen is a seller, buyer is Priya. Is GST payable on these goods? Answer would be no. When you look into third schedule of GST law, there's an entry number 8A. Goods which are sold, which are from a bonded warehouse, are neither supply of goods nor supply of services. So GST applicable is nil. Similarly, Priya has sold the goods to Namita, where the goods are kept in bonded warehouse. So when Priya is selling the goods for 17,25,000, Priya also doesn't charge IGST or any GST. But he also continues to enjoy the exemption, referring to Schedule 3 of GST law. When Namita, she is a person who has to file bill of entry for clearance. So what happens here? When Namita clears material from bonded warehouse, she will pay basic customs duty. She'll also pay IGST on these goods. Now the question comes here. When basic customs duty and IGST has to be paid, the question comes here is, what should be the value? When I have to pay, when Namita has to pay basic customs duty, can she go with the original invoice given by the manufacturer and say, sir, the actual value of goods imported is 12,50,000. On this, you permit to me to pay basic customs duty and IGST. Authority says nothing doing because the last value traded is 17,25,000. On this value, you're going to pay your customs duty and also IGST. This is a concept which is discussed as an additional duty under section 3, subsection 8A, where goods are cleared from bonded warehouse. So here two concepts you have to study. First concept is implementation of 8A under GST Act, where goods sold by Navi, goods sold by Priya doesn't attract any GST. Finally, when Namita is going to file a bill of entry for home consumption, she would pay the tax on the value called 17,25,000. This is one point which is also connected with my section 14. When we come to the next session, you will understand the priority of bonds and the goods which are cleared from bonded warehouse. Now, so what if Namita is not clearing 100%? She's only clearing 50% of the goods. Whatever proportionately was sold by Naveen to Priya, Priya to Namita, I'll go with the same concept. Now, this is what we have discussed. When the goods are cleared from bonded warehouse, there is no applicability of GST because it is a Schedule 3 commodity. Now, protective duty, section 6. Protective duty under section 6 and section 7. Very, very important way where the government of India noticed that there is an immediate attention to protect the industry, to protect a particular set of businessmen. That point in time, they may invoke this provision called protective duty. Now, this protective duty, there are two reasons attached. One, reason of augmenting revenue. Second, to protect the interest of the industry. In that particular case, the protective duty can be levied. As of today, if you look at the reasoning, the notifications which are issued, government can impose something called protective duty to increase revenue or to protect the interest of a particular businessman. So how does it happen? Where there's a possibility that some cheap imported articles are imported into the domestic market. That point in time, government may think of imposing something called revenue duty or protective duty. Now, this revenue duty with the interest of increasing revenue. Now, there is someone called Tariff Commission. I'll give you a little backdrop for many of you who don't know how this works. There is something called TRU. There is something called TRU. Tax Research Unit. The best brains do work in this particular organization. When you start working with the government, like see, there are many things associated in terms of formulation of a policy, a regulation of our tax laws, administrative matters concerned. When you are good in certain aspects, you get adopted, you get inducted to these institutions. The best of brains do work in these research organizations. Like one of the best concept which has come from these organizations is a concept called reverse charge mechanism. Similar mechanism under income tax, you had this concept called TDS. You would have heard this agency called CEA, Chief Economic Advisor, a person who is a advisor to the finance minister. Take it from me, students. Whoever has got a interest on academics, who have got a interest to do something best in the area of your choice, I would advise, think of getting into CEA, think of getting into TRU. And I would give one example at this point in time. Many of you would have heard about this gentleman called Ajit Kumar Doval. This particular gentleman, Ajit Kumar Doval, is one of the inspiring personnel who gives an advisory role on defense matters, security matters to the Prime Minister's office. Ajit Kumar Doval is one classic example when I think of this mechanism called protective duty or as your anti-dumping duty, safeguard duty. This particular tariff commission. So there is an authority called Tariff Commission who reviews how the industry is performing. There should be research done, and that research panel should give advice to the ministry for what to increase the revenue. So this concept of reverse charge mechanism, this concept of TDS, these two are one simple examples where Tariff Commission is going to make advice where the duty should be increased. One, there's a potential to increase the government revenue. Two, there's a potential to protect the industry, which is Indian industry. So as of today, when we think of Section 6, this Tariff Commission, which is established in the year 1951 under the Tariff Commission Act, this particular commission makes an advice to the Ministry of Finance to increase the revenue on certain products where there is no rate of duty applied to compensate the duty which has to be charged. So what they do, they study various nations. Sitting in India, they do the study of UAE, they study Singapore, they study Mauritius, they study US, they study say Brazil, they study Germany. They do a study of various economies and they say, how are the rate of duties fixed in that particular nation? Do we have a level playing field in India to levy a duty on that particular commodity imported? A simple example. You would have seen this particular instrument. I don't know how many of you can see this particular instrument. This is called a pen drive. This is called a storage device. In the year 2000, Y2K, floppy disk. A person who is having a floppy disk is a richest person. Reason, having a computer with a floppy disk to store data. Those days when we have this floppy disk, I don't know how many of you have seen a floppy disk. A floppy disk comes with a storage capacity, which is a kind of a CD in a plastic case. We used to have 16 MB, 250 MB, then later it has come into 1 GB kind of thing. From an MB, the capacity has gone to GB. So this floppy disk, which was later replaced by a CD, compact disk. Later, the CD was replaced with this pen drive. This is a concept called pen drive. Now, Government of India has lost heavily when these plastic components called storage devices were imported. The storage devices were charged heftily when they were imported into US or when they were imported into other nations. However, we were charging very less rate of duty. This particular Tariff Commission of India have realized that there is a potential to increase the revenue when I charge a rate of duty on these storage devices. There was one instance where Minister of Corporate Affairs. Now there are connected instances. If you try to understand, if you try to analyze various activities one to one, there is a lot of business chain. Overnight, Minister of Corporate Affairs has come with a notification saying that Director KYC is mandatory. The moment they say director KYC is mandatory, there is no digital signature class 2, class 3 to be obtained for directors. Exactly a month before this notification has been come in, a consignment of pen drives have been imported from China overnight. The cost of pen drive was worth only 150 to 200 rupees. This particular pen drive, which gets converted as a digital signature, was sold for 750 rupees. Now, the government felt, this particular Tariff Commission of India, they did a thorough analysis. There was a notification from MCA. This MCA has led to increase of import of pen drives, and this import of pen drives overnight, where it has increased much in production. The government said, look, there is a dead cheap imports happening. Let me stop this by imposing something called protective duty under Section 6. So here, just for examination purpose, when we talk about protective duty, it is for the purpose of government to increase the revenue or to protect the industry when there are cheap articles imported into India. Now, the government says that, look, I'm going to levy a protective duty from the date which is notified in my Schedule 1. And this protective duty, when it is levied, it has to be levied on a reference to article which is manufactured in India. So if a pen drive is manufactured in India, they say any pen drive which is imported from 1st August 2020 shall be having a protective duty applicable at the rate of 24%. So what if the goods are not manufactured in India? I fail to levy a protective duty. So to protect the interest of the manufacturers, I may levy a protective duty, or at times to increase my revenue, I may levy protective duty. So this increase or decrease can be done, or imposition of a protective duty can be done with a permission from the parliament, that is upper house, lower house. Most of these duties which are levied, they don't have a prior permission from parliament. This is a post process. Reason, when government has to take an action, they cannot expect the parliament to function, because the parliament meets occasionally and they don't have time to meet, sit and discuss on every day. So what the government, the ministry will do, the Minister of Finance will start issuing notifications. Whenever the parliament meets for discussion, they present this notification for approval. So whenever a notification is given, what can happen? Parliament may approve, Parliament may make a modification, Parliament may set aside. When Parliament is approving, it continues as it is prior to approval. Parliament has approved with a modification. The day they have passed this particular notification with a modification, from that day, the modifications will prevail. So what will happen prior to that modification? With a good intent, government has done, so nothing of any violation will be deemed to be existence. It will continue till the date of Parliament approval in original form. But from the day the Parliament has passed that notification, the modified version will continue. What if Parliament has not approved this particular notification? So if the Parliament is not approved this notification, from the day the Parliament stopped giving approval, this preventive duty will not be there, protective duty will not be there. But the period, from this period till the date of approval, whatever duty was levied, it shall be deemed that it is done in a good intention, and that gets prevailed. No one can challenge saying that, sir, the Parliament has set aside. So this period to this period where the Parliament is approved, any notification which was imposed, that shall hold good. This is the purpose of my protective duty. Next, emergency power. As the name goes, emergency. They feel that there is some emergency to impose or enhance. So Section 8 deals with this particular emergency. Emergency on imports, emergency on exports. So Section 8 talks about your export duty. My Section 8 says that I can levy a export duty or I can enhance an export duty. Central government has a power to enhance export duty or to make an amendment to second schedule to impose. There are two aspects here. Examination, expect one question from this particular section 8. What it says, sir, a particular commodity under second schedule is not covered, is not notified. When we look at my second schedule, there is a list of commodities. On a particular date, when government wants to impose export duty, there's a particular commodity which is not notified. Now, government can invoke section 8. What they can do, imposing a customs duty by way of notifying a commodity which is not notified. Example, say there is a product which is made of rice. Example, my rice product, let's take this in South India. In South India, this out of rice, there are various products manufactured. Similarly, in North India, out of wheat, we have this roti, paratha kind of stuff. Assuming for a moment, there's a product or commodity which is a byproduct or which is a commodity manufactured of a main ingredient which is not notified, Government has a right, government has an authority for what? For imposing, that is, they notify. Whichever is not notified, they will impose by way of a notification. So they have power to add few items to this second schedule. Whatever items are there in second schedule, if something is missing, they can notify. And what they can do by way of this notification, they may impose a export duty. Sir, onions which are onions which are produced in India are being exported. I want to stop that particular onion. Now there is a very brainy exporter. What he will do, instead of exporting onions, he will add onions to say wheat or rice. He will make that as a commodity, as a new ingredient. He knows that an onion which is cut, which is put into potato or which is put into wheat and packed, it has got a life of 7 days. But some sort of thought process. He notices that a particular commodity has no entry in my second schedule. To overcome this export duty, he comes with a new product. Government notices that since this product is not notified, the exporter is taking an undue advantage. So government has the power to notify such product and impose or enhance the customs duty. Now, this is the importance of section 8. Moving on, section 8A. Now, like there is a special power under 8, there is a special power under section 8A for imports. Now here, government may impose or enhance, impose is not there. Central government may enhance. Reference to page number 2.10 of your institute material. Now, the goods which are notified in first schedule, only on those goods, government may impose import duties by way of a notification in official gazette, and that goods should be specified in first schedule. Unlike your second schedule, so there is no entry. I can make an entry of those goods under second schedule. But in case of first schedule, only those goods which are specified, I can impose with a special power. Now, while imposing this particular import duty, the article, there should be a reason why the government wants to impose this safeguard measures. The government feels that there is a existence of a circumstance where this safeguard duty. Now, I call this as safeguard duty under section 8B. Under section 8B, I call this as a safeguard duty. Government feels that the articles are being imposed in increased quantities, or this importation is causing a threat to the or serious injury to the domestic industry. Now, some of you may question, sir, you have explained something called section 3, subsection 7, IGST can be imposed. So you have spoken about section 6 called protection duty. Now you are talking about section 8, where your safeguard duty is being imposed. What is the difference between these? Now, protection duty, this particular protective duty can be imposed when there is a manufacturing activity happening here. But in case of safeguard duty, I can go ahead irrespective of manufacturing duty. What is the backdrop required? There is a sudden import of increase. Government feels that some commodities are getting imported with the increased quantity. Now there is something called statistics. So this I was talking to you on TRU. What is the purpose of this TRU? Like I spoke something on Chief Economic Advisor. So what do? They have this job of examining what is happening every day, which industry, how they are performing. When the quarterly financials are, there is something called quarterly results. When the financials are published, when the your results are quarterly announced, they see what is the growth year on year, what is the impact on a particular industry, what industry is doing well, what industry is not doing well. When a particular government policy was brought in, how was the reaction in the trade and the industry? How the exports happened, how the imports happened. What is the impact of my RBI? How my inflation happening? What is the purchase of your currency factor? How my dollar is behaving? There are various factors which are analyzed together for deciding, should I invoke section 6? Should I invoke section 7? Should I invoke section 8? Should I invoke section 9? So this is how this TRU along with CEA makes a recommendation to the finance ministry, finance revenue. And just keep in mind, students, post-qualification who are very interested to do this sort of research, I would say customs is one area you get a CE exposure in terms of understanding how does the industry do function. Now, when I was talking about this safeguard measures with respect to increased quantities, so what is the job they do? They analyze on a daily basis. What is the volume of material which is importing? How much quantity of goods lying in the customs for clearance purpose? How much of quantity has come for the purpose of export purpose? Do they stop there? They don't stop there. They also go one step beyond. Now, from Germany, some goods are imported. From Japan, some goods are imported. From China, some goods are imported. They understand what is the volume of imports happening in that particular nation, and from there, was there a dumping which is happening? Now, this is how they analyze various aspects, and then they give a recommendation to the government. So this particular industry, I would say hats off. It is as good as dedicating your life or showing your passion to the soil, that is Indian nation. Like military or army, what we say, getting into this particular research unit is next to something which is not that easily possible. People of good academical track record, people of very good, promising career, advisory role, people who come with an innovative thought process. Now, to all this, there is something called data analytics. Along with your curriculum, if you can add this degree called data analytics, very bright future is there to this data analytics read with these particular provisions. What you will do, you will analyze how is the pattern, you will analyze how is the consumption, you will analyze what is the revenue. Having a professional degree, chartered accountancy, all this will add you to get into a better fulcrum of giving advice to the government of India. Not that easy. And you should be passionate of being in that particular spectrum. Now, when we talk about this section 8B, I was talking about something called safeguard measures. Government has to impose this duty 8B to protect the interest of a particular business. How does the safeguard happens? My safeguard can happen by way of a imposition of a safeguard duty. So first thing I will do is, sir, please levy a duty. The moment I levy a duty, what happens? The cost of imports increases so that I make a level playing field for the goods available in India, the goods which are being imported. This is the first choice. Second choice, application of tariff rate quota, TRQ. Very important. Examination, please expect a 4 marks question on TRQ. Many of you, when I say again, not that everyone has an exposure in customs law, but there are few hand-picked topics which should be tested in your examination. This TRQ, tariff rate quota, we call this as tariff rate quota. Now, this TRQ again is a brainchild of Tariff Commission, where on the application filed by an applicant, they fix something called tariff rate quota. That means they say that I'll restrict. How? On the basis of tariff rate, how many goods can be imported? I, as a customs officer, will decide. From Indonesia, let this many products be imported. From Taiwan, let these many volume of goods be imported. So what I will do, whatever goods are being imported into India, I decide that based on the activity of imports, I'll fix nation-wise or person-wise a quota, which is called tariff rate quota. This TRQ is a second measure, or any other measures where central government may deem appropriate. Choice of these two, or restricting something else, or avoiding the import itself. So the government, whenever they want to invoke provisions of Section 8B, which deals with your safeguard measures, first and simple thing, impose safeguard duty. Sir, this is not the best choice. Then go for TRQ, fixing TRQ, that is tariff rate quota. Central government may allocate TRQ to the supplying countries. So whenever we talk about TRQ, this is nation specific. Nation specific. I can take a call from China, how many goods to be imported? From Japan, how many goods to be imported? From Brazil, how many goods to be imported? So this is TRQ, which is a very good function where the government decides, let me restrict this particular volume. And this safeguard duty is in addition to customs duty, addition to additional duty. Now, in doing so, the government may come with a proposal. Sir, how do you fix TRQ? Now, how do you know that you should restrict the goods which are coming from China, goods which are coming from Myanmar, goods which are coming from, say, Taiwan? What they do an analysis of last 3 years. What was the last 3 years average? Let me do a trend analysis. On the basis of this, I fix a TRQ for each nation. So nation-wise, when the government wants to fix this TRQ, what is TRQ? Tariff rate quota, means they fix upon what is the volume, what is the quantity of goods which can be imported. This fixing of TRQ is specific to a particular nation. So what is the base? I'll take the last 3 years average. And what is the tenure for fixing safeguard duty? I can levy this particular duty for a period of 4 years. But if I want to continue, that is, government feels that this safeguard duty is required because the indigenous manufacture is not picking up. Maximum for a period of 10 years, government may think of imposing safeguard duty. Now imagine, these are all advisory aspects which come from the TRU. What they do, they give advice. Look, this European nations, they have this measure. When there is a fall of banking system, this particular economy, there was a collapse. Like, your Britain, there was one particular instant where entire financial system got collapsed. Finance minister gave up his hand saying that inflation is so high, I cannot control this particular instance. When things got collapsed, the research team does an analysis of those particular instances and they come with this particular advisory things. So TRQ is one particular concept Please expect from examination 4 marks question. Tariff, rate, quota, fixing. Moving further. In TRQ, whenever they think this concept of fixing TRQ, they have to keep in mind something called WTO norms, World Trade Organization norms. Now, World Trade Organization as a big brother comes in terms of settling the disputes. For a moment, for an instance, China complains to WTO saying that, look, Indian government has imposed so much of restriction. It is causing an undue hardship and it is in violation of your national treaty. Then WTO has come with this mathematics saying that, look, whenever you are fixing this TRQ, please ensure that it does not exceed 3% of the total imports. Means your TRQ should be keeping as a benchmark when you do a calculation of total value of goods imported from China and this particular commodity alone. This should not be exceeding 3% of the total imports. That's how you cap your TRQ. So what if these goods are not imported only from China? It comes from Myanmar, it comes from another nation called Nepal or Burma. From Burma, the goods are getting imported. From Myanmar, the goods are getting imported. Also, China, the goods are importing. Then, good. Individual country level, nation level, I'll keep a cap of 3%. All those goods aggregate, I'll keep a cap of 9%. This is how they decide how to keep a cap in conjunction with your practices at a global level. So they say that whenever I'm fixing a TRQ, there should not be a interest which is against of a particular nation. So they say that I'll keep a cap of 3% at a nation level. I'll keep a cap of 9% at all nations level. There's a restriction on imports by EOU SSN. Little important point. We are at 8:1. Let's have a break for 5 minutes and then let us resume back. 8:5 sharp will resume back. with this discussion. Let me quickly see if there are any questions so far. There's one question from Sumit. So what is the difference between project import duty and preferential rate of duty? Sumit, project imports is the fag end of our discussion. But however, since you have raised this question, project imports is a mechanism where under Central Excise, Customs Tariff Act, there is a chapter called 98. All project imports are classified under chapter 98. Simple reason. So when you are setting up a factory, Sumit, you need to import machinery, along with machinery, some of spare parts and components. Now, machinery, I can have a classification. So spare parts and components, it is so complex that I have so many variants of components. How do I classify them? So my project imports entry number 98 comes and says that all your setup required machinery for which whatever ancillary spare parts are there, these spare parts are classified with the main product. Whatever is the rate applicable for main product, the same rate is applicable for the ancillary products. This is called project imports. On the other hand, preferential rate of duty. Now, preferential rate of duty is a concept which has come to say that any goods which are imported from a preferential area where they have to give an importance because of a treaty, national treaty between two nations, have to give a concession rate of duty. That's called preferential rate of duty. So the importer will go to the customs officer and gives a declaration that, so these are the goods of preferential interest from so-and-so preferential area. So this is a difference between project imports and preferential duty. Hope this is clear, Sumit. And there is one question from Naveen. So 9% of total imports to India from developing nations or all nations? From developing nations. Developing nations are the part of nations from your WTO. So all these developing nations from WTO, like why this condition has been put, Naveen, if you understand the backdrop, when we're talking about 9%, because there is a complaints with the World Trade Organization policies, all those entities which have been listed themselves as developing nations, for them I have to go with this now. So answer, Naveen, it's all for the developing countries. Now, there is a next point in our discussion called applicability of the safeguard duty for my SCZ or a EOU examination. Expect again a 4 marks TRQ read with a SCZ or EOU. Now, this is the funniest provision. I don't see why this has been inserted in this fashion. Section 8B, which talks about safeguard duty. Applicability to SCZ or EOU. They say this particular safeguard duty is not applicable unless it is not applicable to SCZ unless specific reference of SCZ or EOU in such notification. So they say that whenever the government has issued a notification, they should mention clearly this safeguard duty is applicable on all imports imported by a SCZ or EOU. Now, why do they mention that? Goods which come to SCZ get exported back out of India. So for that reason, generally SCZ and EOU, they don't mention. So whenever we talk about safeguard duty, especially in case of SCZ EOU, unless the notification specifies that this SGD is applicable to EOU SCZ, it shall not be applicable. Point number 2. If those goods are cleared as such from SCZ or EOU or after manufacture, clearance to DTA. So what they say, when SCZ or EOU has imported that particular material, and that particular imported material, they have just cleared as it is to a domestic tariff area. Like example, Say I'm an entity, I have a registration in the SEZ location. These goods which I have imported, I have imported in a SEZ. From SEZ, I just debonded and taken to DTA. Now there, I can say that this is an indirect route. Goods are coming from one nation to SEZ. Government felt that SEZ it is not applicable. From SEZ, it has come to DTA. To plug this particular loophole, they say that the moment goods are coming from SEZ to DTA, safeguard duty has to be paid. So what if I use that material in my manufacture and then I remove to DTA? Because this particular commodity was used in your process, whatever is your value of sale, on that proportionate value of this purchase should be subjected to safeguard duty. Like example, your raw material, your labor, and your overheads. Assuming raw material is 150, labor is 25, overheads is 12. My total composition is 187. This is my cost. And margin, say 10% into 10%. Sale price is 187 plus 18.7. This is my sale price. Now look at the beauty. Assuming that in raw material, 25% is a dependency of safeguard duty material. SEZ has imported and used it for its manufacture. Out of total raw material, 25% is a dependency on this particular raw material. So what they say, first you look at your dependency of 150 on total cost. It is 80%. So what they say, on sale value, apply your dependency. On that, 0.25 happens to be the value on which you should pay safeguard duty. So SGD is payable on $41.25. This is how the duty, safeguard duty is payable when goods are cleared from your SEZ or EOU. Next. Before I come to my section 9, let me see if there are any questions. So far, so good. Now, next, after your safeguard duty, I move on to something called subsidized articles. Now, when I was going through these aspects, I was looking how the industry is behaving, how the market is behaving. Unfortunately, these commodities, safeguard duty, protective duty, these are the various commodities. Majority of these products are linked with China. Example, there was something called hot rolled steel flags. There is something called tampered glass. Now, whenever we see a notification which was issued under this section 8 or section 9 or section 6, first entry comes from China. Now, this is how goods are getting routed through India from various places. And by the way, while we are discussing on section 8B, there is something called provisional duty. I've just skipped the provisional duty, considering the least importance of that particular concept. Only the essence of the sections I'm covering for your academic interest. So this concept of subsidized articles, where there are conditions. Government believes that there is a condition to satisfy themselves. What is that? A particular country or a territory, directly or indirectly. Look at the language. Directly or indirectly pays or bestows subsidy. So this particular country or this particular territory gives something called subsidy. For what? Upon the manufacture, production or exportation of an article, subsidy is also to include transportation. So government feels that a particular country or a territory, either directly or indirectly, they are giving a subsidy. They are giving a subsidy for what? For manufacture or production or exportation of a particular commodity from that particular nation. So if this condition is there, they feel that there is a subsidy which is happening. And these goods are imported into India. And this article may be imported in the same condition as when exported from the country, or manufactured production, or maybe changed in the condition, or otherwise. So these particular commodities may be imported in the same fashion, or slight change may take place. Right? Now, look at the challenge comes to the customs authorities. When I was talking about this particular point, there are multiple challenges for a customs officer to watch on these things. Like I was talking about this hot rolled SS flags, or this tampered film, tampered glass. These commodities, like there are few cheap tactics by these nations. What they do? Commodity goes from China to Burma. From Burma, it enters to India. Now, what is happening here? China, the public PR of China, they have given a subsidy to export a commodity at a subsidized price from that particular nation. Now, they don't say, you export, I'll give you an incentive. This is an indirect way to kill a domestic market, where they say subsidy. Now, that's why the heading says subsidized articles. The moment students examination, the moment you look at your heading, you should correlate with these examples so that you can present your concept easily. So government feels that there is a territory or country directly or indirectly. Now, directly or indirectly, when I say indirect, there could be an agency who is encouraging. There could be a government who formulated a law directly. Like example, DGFT. Revenue department, when I export the goods, I get a drawback. When I export the goods, I get a script from DGFT. When I export the goods, I could have local authority who gives me an incentive. So there is an incentive which is given directly to the manufacturer or indirectly to the manufacturer. For what? A subsidy. So whenever there is a subsidy given for production or manufacture, for goods which are exported, then government feels that something is wrong. Now, this is the challenge I was mentioning. Circumvent measures, to conceal with the intention to deceive. Circumvent measures where there is an alteration of the description or the name or the composition. At times, the importer who is there in India, to overcome this subsidy duty, what they may do, they may change the description, they may change the name, they may change the composition. So when they import the material, like example, so this is a porcelain cup. This is a porcelain cup. I don't call this as a porcelain cup. I call this as, say, plastic cup. Now, plastic cup is dead cheap compared to another metal. So I change the description. I change the nomenclature just to avoid my subsidies duty. So I import as a plastic cup, I just pay 12%. But actually, if it happens to be 28%, I lose out on rate of customs duty. So there could be tactics. This is called circumvent measures. Or by import of such article in unassembled or disassembled form. Look at the intelligence. This particular pen, I don't import as a pen. I import pen separately. I import refill separately. I import the exterior part separately. Sir, I'll say, sir, this is not a pen. Sir, these are all spare parts for a stationery. Why? It is in unassembled form. Now, I can challenge in Supreme Court or High Court saying that, sir, what is there in tariff and what I imported is different. Now, this argument may come. That's why cautiously they say the goods may come in a assembled or disassembled form by changing the country of its origin of export. Now, this point, there are rules. When you read these rules, students, you will love. You really appreciate so much of thought process goes behind formulating these rules. So what they have done, there could be a possibility that from China, it has gone to Burma. From Burma, it has come back to India. Now, they have to establish that the origination of export or export. So here what they do, the exporter from Burma gives a declaration that it is manufactured in Burma. He gives a declaration there. Now, here, to ascertain that it is manufactured in Burma, they have gone to the extent of saying that, what is your cost of production? Tell me from where you have imported raw materials. Tell me what is your labor, what is your administrative overheads, and what is your profit margin. Based on this, you derive your price and give it to me. Once you give this data, I'll say whether this origination is from China or it is originated from Burma. Now, there are various commodities. If you see a notification, they have actually pinpointed and say, so-and-so exported from China, so-and-so commodity from China has to subject it to subsidized duty. Now, this is how the intelligence went to the extent of identifying and levying a duty called Section 9 subsidized duty. Also, so the government may tackle these aspects again where the importer tries to deceive to protect their interest. Now, whenever government wants to levy this subsidized duty, they say this is called countervailing duty, CVD. I call this as CVD. Why? Countervailing duty. It is to match, counter. It is to counter the subsidy. My CVD is levied to match the amount of subsidy given. That's why I call CVD, countervailing duty. So this countervailing duty shall not exceed the amount of subsidy. So here there is a clear-cut evidence. So-and-so nation has given so much of subsidy, the goods which are exported from that nation. So when there is a order, when there is a government order issued, and the government order says, per metric ton, I give you so much of dollars, so much of percentage. That particular amount should be levied as your countervailing duty. And this is in addition to the other duties. So I charge basic customs duty, I charge additional duty, I also charge countervailing duty. And whenever you're charging countervailing duty, it is not to be levied. Like, no, you have to levy only when there is a subsidy given in relation to export performance. Means the exporting nation, the exporter, they have given a subsidy in relation to export performance. And this subsidy is used for domestic products which are used in the goods meant for export of article. So the government says that those goods which are imported and used for export, I'll give a subsidy. They're trying to convenience, they're trying to evade this particular duty for taking away the domestic competition. This subsidy has been conferred on a limited number of persons who is engaged in manufacturing or production. There are few instances where the government of that particular nation says these are the agencies who have been vested with this particular subsidy. So when there is a evidence established, now those are the cases where levy of this subsidized duty under Section 9 comes into picture. I was giving an example of this Ajit Doval. Why I was talking about Ajit Doval? So much of confidence, so much of information needs to be collated to establish that there is a subsidy which has been given. Now, how much of R&D? Put yourself into the shoes of the lawmaker to visualize how this information has to be gathered. Now, for this particular CVD, 5 years is the time limit. Government can extend maximum another 5 years. Next, another important aspect comes here: anti-dumping duty. Section 9A covers this anti-dumping duty. Section 9 covers your countervailing duty of subsidy. 9A talks about your additional anti-dumping duty. Now, this is a clear case of your monopoly. Now, when I was talking about all these provisions, some of you might be thinking, so how do we use these particular provisions? Where can we apply these learnings? But this is a kind of research work which can be used elsewhere. I draw your attention to this one case which was confirmed in 2021 in case of Competition Commission of India, where Competition Commission of India has levied on a particular manufacturer of a motor vehicle. I'll not name the company. The manufacturer of a motor vehicle has imposed the restrictions of giving a discount. When the motor vehicle has to be sold in India, various dealers have been appointed and the vehicle has to be sold. This manufacturer has controlled nationwide dealers. You buy that particular vehicle, either in South India, East India, North India, you get the same rate any dealer you go. That's how this manufacturer has controlled by imposing all this set of duties. He didn't call as a duty, safeguard duty, protect duty, your subsidized duty, subsidized penalty. These concepts were brought into an agreement called dealership agreement. By virtue of invoking this dealership agreement, the prices were controlled by the manufacturer. Looking at this, the Competition Commission of India said, look, this is a monopoly. There is no oligopoly. Because you're controlling, you're ruining, you're commanding the price. This is against the principles of fixing a selling price. We levy a particular compensation. Some 120 crores was demanded as a penalty for imposing that particular strict pricing norms. Now, just a backdrop, how these particular tactics can be used in your business. If you happen to be advisory to a marketing company, if you happen to be advisory to a particular manufacturing company. Right? Moving further, anti-dumping duty. Export price of a product imported into India is less than the normal value. So a commodity which is sold in a particular market, and if that particular commodity imported into India, say the value sold in territory 1, assuming territory 1, within territory 1, if the product has to be sold, it is sold for $125 US. And this particular commodity, if it has to be exported to India, the same product has been sold for $100. Now, this is a gap of $25. What do you see here? Gap of $25. Export price of a product imported into India is less than the normal value of the like articles sold in the domestic market of the exporter. So in this particular domestic market, whatever is being sold is less, but this value is higher compared to the value which is exported to India. This additional duty can be imposed only when there is a Indian industry which manufactures those articles. So coming back to the principle, like we have discussed in protective duty, anti-dumping duty can be imposed only when there is a manufacturer in India. So this anti-dumping duty can be invoked only when there is a manufacturing activity. So if there is no manufacturing activity, then imposition of anti-dumping duty cannot be thought of. And this duty is country specific. So whenever the government of India wants to levy anti-dumping duty, this is specific to a nation, like goods imported from Burma, goods imported from China. Couple of examples to give here. As of today, if you see this anti-dumping duty, goods imported from China, axle for trailers, goods imported from China, PVC flex pipe, PVC flex films. These are the two commodities, again, which are imported from China. There is an anti-dumping duty because there is a local manufacturer like Mahindra and Mahindra. They manufacture this axle for trailers. These axle for trailers, Ashok Leyland also manufactures. If those are imported from China at a dead cheap price, now it is going to kill your cutthroat competition in India. So as of today, anti-dumping duty is imposed only if there are local manufacturers of that particular product. And this anti-dumping duty is country specific. That is, any goods imported from that particular nation, anti-dumping duty will be imposed. Now, there is something called like WTO, General Agreement of Tariff and Trade. Like similar to WTO, I have general agreement to tariff and trade. So what they say, Once you have signed an agreement as per GATT, your anti-dumping duty cannot exceed what is that? Margin of dumping. So, like the previous example, $125 is sold in that nation. Goods exported out of that nation is $100. So, what is the margin of dumping? $25. When you levy anti-dumping duty, it shall not exceed that $25. However, a lesser duty can be imposed called injury, to remove injury, which is there in the domestic industry. So what they do, they have choice. One, you go with the dumping of margin, or go with your injury cost, which is in your domestic market. So if those goods, like the trailer which was imported from China, this trailer was manufactured by Ashok Leyland, was costing say 1,25,000. The same goods which are imported from China was worth say 1 lakh. There's a gap of 25,000. Either 25,000 injury or the gap of say 75,000 of margin of dumping. Whichever is beneficial, you can choose. Whichever is lower generally. Now, whenever the government wants to impose anti-dumping duty, government has to present that notification before the parliament. Now, for the purpose of anti-dumping duty, my anti-dumping duty shall be lower of. Examination, they'll give you a problem. They'll give you a margin of dumping, they'll give you an injury margin. Whichever is lower, I have to adopt. What is this margin of dumping? The value in that territory, compared with the value exports. Injury margin, which is given by the local manufacturer or producer. My local manufacturer produces this, sir, I sell in India this value, and the value which is imported is at this value. So I compare X manufactured in India with Y which is imported, or the margin which is caused in the originating nation. The least of these two will be considered. Moving further. My margin of dumping, there is a formula what they have given. The margin of dumping is calculated as the normal price in that nation compared with the export price. Like example I have given, $125 if it is sold in that particular nation. The same is exported for a value of say $100. Why do they do that? To kill that particular market. So if this is established, this I call as margin of dumping. Similarly, export price. Export price is the price which is exported from that nation. So what if I don't have that export price? There's something called construed export price. Now, this anti-dumping duty can also happen such a way that goods from China go to a particular Burma. From Burma, it is coming back to India. Then this is called a tri-party transaction. So I can derive either directly from China, or I do interpretation on the basis of rules which have been formulated. So what if it is not established? Like there is a tri-party arrangement. Goods have not come directly from China. It has come with two different nations. Then the government says, look, if that is not possible, look at the resale value to an independent buyer. The goods which are sold for the first time to independent buyer, that shall be considered as your export price. Like at times, it so happens that goods from one nation to another nation to India. So in India, if you sell for the particular independent buyer, that will be considered as your export price. So what if the goods are not sold, manufactured? Then there are rules formulated for anti-dumping duty. Little technical. When you get in depth, you will understand how this calculation happens. And normal price, the price which is manufactured in India, this normal price is compared with the price which has been imported. Now, the injury margin is nothing but face selling price in India compared with landed value. This gives me my margin of injury. Margin of injury. This is called calculation of first injury, second is your dumping. Now, similar to your SEZ, there's a provision called EOU. Anti-dumping duty is not applicable to EOU until the notification says that it is specifically applicable. So any goods which are imported by EOU, why they don't specify EOU? EOU brings the goods and exports back out of India. So they feel that there is no loss to the domestic industry. However, sir, what if the goods are cleared from EOU to domestic tariff area? In those cases, yes, this anti-dumping duty is applicable. Sir, if they use in manufacturing, don't worry. Whatever equation we have studied for SEZ, that is your safeguard duty, same principle you apply for EOU. And this one new mechanism called retrospective effect. Now, this is one new theory which was brought by the government. At times, it is not possible for the government to visualize that there is anti-dumping duty, anti-dumping which is happening. Reason, you should have suffered, then only you will get to know that this is a pain of suffer. Like when you fall sick, you will sit and analyze, why did I fall sick? Today morning I got up, I went to the park, I did walking for half an hour, I came back. From there I went to a local shop, I purchased some grocery items, I've come back. Now you will try to understand, did I got exposed in park? Did I got exposed in the grocery shop? You're trying to analyze. Same way is your anti-dumping duty. Upfront, no one knows that there is a dumping which is happening. How do we get to know? Sir, I have been selling this chassis manufactured by Ashok Leyland for 20 years. All of a sudden, I see that my chassis, every month, I manufacture 15 chassis. For last 2 months, I have been noticing that this 15 has become 5. I checked with my customer. What is the reason you are not placing the order? They say that, so the goods imported are much cheaper than the domestic manufacture. Then this particular officer concerned does an analysis and says, look, the goods which are imported from so-and-so nation have been subjected to anti-dumping duty. That is the reason they brought this mechanism called retrospective effect. That means the day when the notification comes, this levy can travel back 90 days from such notification. I repeat, the day the notification has come into existence, from that day in time, I travel back 90 days to say all the clearances happened from the day 1 till the 90th day, that is till the date of notification, shall be subjected to anti-dumping duty. Sir, is it a wise mechanism? Reason, anti-dumping duty, I can find out only when there is a suffering. Because there is a pain, I have to travel back in time to analyze. In the process of analyzing, my law has permitted me to travel 90 days. So government felt that from the day notifications come, you travel back 90 days. And so what is the time limit for continuing this anti-dumping duty? Generally up to 5 years. If government feels it is required, they may continue for another 5 years. As long as the exporting nation is very strong in terms of dumping. Unfortunately, there are a few notifications. 2012 were rescinded in 2018. It took 6 years for the government to withdraw anti-dumping duty on a particular commodity. Next, examination. This you can expect one theory question for 4 marks. This particular will be tested for 4 marks in your examination. I draw your attention to page number 2.25. Page number 2.25 of Institute material, which describes this particular exception rule. So this particular theory can be tested for 4 marks in your examination. My section 9b says that, look, you have a good intention of subsidy under section 9, anti-dumping duty under 9a. Subsidy, anti-dumping duty cannot be levied together for the same objective. I repeat, same objective. So if you have same objective, I cannot levy countervailing duty and your anti-dumping duty. Your CVD and ADD should not be for the same objective. If it is for 2 different objectives, yes, I uphold. This is the first exception. And further, they say, if those goods are exempt from duties or taxes. In the regular course of business, if those goods are exempted from the duties and taxes, which is meant for consumption in that country, or which is meant for exportation, for refund of such duties and taxes. If it is a general practice, please don't levy CVD. Please don't levy anti-dumping duty. Now, an importer who happens to be a genuine importer can challenge this particular levy in a high court, or it can be challenged in a tribunal. So for that purpose, government has made it very clear. Look, you can levy a CVD, you can levy a your ADD, anti-dumping duty, only if it is a exceptional. Let me have given an example. These are the parties who have been notified for subsidy. So when you are giving subsidy, which is not regular practice, then existence of CVD is valid. If the government of a particular nation has given a refund, like a duty drawback, what happens in India? Any goods exported of India, 2% is a duty drawback available. So which is as good as a refund. So if it is a regular practice, don't levy CVD or additional duty, anti-dumping duty. Third point. There is something called, as per WTO, there is a member country of a WTO. If the goods are originating from a member country, until and unless you feel that there is a threat, there is a material evidence of injury to a particular industry, don't levy CVD or ADD. Now, look, I have been a party to World Trade Agreement, World Trade Organization. Like India, China also is a part of World Trade Organization. Like China, Burma is also part of World Trade Organization. So this particular provision says that, look, whoever happens to be the member country of a World Trade Organization, don't impose your CVD or ADD under 9 or 9A. However, they say, if there is a threat to Indian market, threat to Indian manufacturer, please go ahead and levy CVD and your ADD. Illustration number 3 of page number 2.25, a simple illustration. Please wait and watch for a 3 question for 4 marks in your examination. This is the importance of 9A, which is exempted under 9B. Next, moving on. Levy of social welfare surcharge. This is a 10% surcharge. Unfortunately, see, this levy of a surcharge is for a good cause. What they say, I want education, I want health, I want social security. Good. As a government, you ensure the protection of your civilians. So all this money to be spent on health, infrastructure, education should have been funded from somewhere. So what government has said earlier to this Finance Act 2018, education says, special higher education says, health says, something else was there, sugar says. There were various says collected in different fashion. So all these have been put to an end where government said, like, no, there was 2%, there was 4%, there was 1%. Now let me do away all this chunna munna cess and let me come with one cess called social welfare surcharge. They've changed the name, surcharge. For what? This money is to fund education. This money is to fund health. This money is to fund social security. And what is the rate? 10%. This particular 10% is levied on duties and taxes which are collected under Section 12 of Customs Act 1962. So for levying my social welfare surcharge, I'll exclude what all things. One is safeguard duty. Second is your CVD additional duty or your social welfare surcharge itself. All these duties I'll exclude. So precisely, this is nothing but I apply 10% on basic customs duty. Whatever I collect as basic customs duty, on that straight away 10% is applied called social welfare surcharge. Now, one point of caution here. Government itself doesn't have a track from where this money is being collected, for what purpose money is being spent, and how much is the accountability. This is the state of affairs when these cess or taxes is collected. accountability does not get into existence. From here, we move on to classification, which is the next topic meant for today's discussion. Let me open this PDF files to show you how my first schedule and second schedule looks like. First, I'll show you this schedule, students. Then I'll come back to explain this classification. Let me just come to my PDF. Yeah. So here, this is called first schedule. This is called first schedule. Hope this PDF is visible now for everyone. This is called first schedule. You can see here. Let me just go a little up to make it here. Yeah. So if you see this first schedule, students, there's something called tariff item. Under this tariff item, you can see 8-digit entry, 4-digit entry, 6-digit entry. So this is 4-digit, this is 8-digit, and this is 6-digit. So my standard HSN at a global wide is 6. Whenever I export goods, whenever I import goods, I should have 6 level digits to be quoted on my airway bill or to be quoted on my shipping bill. For each of these tariff items, there is something called description. You can see here live horse, asses, mule, and hints. There's a unit of measurements, units. And there's a rate of duty, standard rate of duty, preferential rate of duty. Not that every commodity will have preferential rate of duty, but say your regular duty is there for every commodity. And in this process, you can see here, there is a single dash, there is a 2 dash, there is a 3 dash. So when I look into my HSN, this is called heading. This is called heading. This horse is a subheading of this particular entry. Single digit indicates whatever is there in the main heading is elaborated in the single dash. This double dash indicates that, sir, under this horses, this is a further level of bifurcation. First, they say live horses, asses, mules, and hands. Now, this is one classification. What they say? Live horse, asses, mules, and hinds. Under that, first level classification is horse. This horse was second level bifurcated as purebred breeding animals. Now, this is the way they classify the commodities. Let me go further to show some interesting aspects. Chapter 84, 85, that will be a little interesting to understand. Now, look at this milk. Now, if you look at the milk, now look at these entries. Milk and cream, not concentrated nor containing added sugar or other sweetening matter. So under this 0401, there is a entry at 8-digit level. So this single digit indicates that this is explaining this. Again, a single digit indicates that this is again referring to the main heading. If a single digit is followed by double digit, this then it is indicating that it is a explanation to the above item. So here, all these are single digits, single dash, which indicates that fat content, weight not exceeding 1%, fat content exceeding 1%, but not 6%. So on the basis of fat, my rate of duty has been fixed and my classification is fixed. Now, this is all your first tariff. First schedule means the goods which are imported into India. From here, I'll come to second schedule. My second schedule is indication that this is a schedule for exports. This is meant for exports. So don't imagine that exports are free. Government of India feels that goods which should not be exported or They want to make not economical to export those goods considering the national importance. What are the items? Coffee, tea, black pepper, turmeric, mica, iron concentrate, hides, skin, leather, jute manufacturers, jute, pig iron, alloy steel, flat rolled alloy steel, tubes and pipes. Now you can see just 2-3 pages are covered in relation to exports. And how is that export duty fixed upon? If you refer to coffee, for coffee which is exported, they say for every quintal there is an export duty of rupees 2,200. So they are making it not that economical because they feel coffee is of very important to the local domestic market. Similarly, tea, for every kilogram, for every kg, 5 rupees happens to be my export duty. So this is the importance of your first schedule and second schedule. So let me come back to my presentation. Now, as of today, as you are aware, my Customs Tariff Act has got first schedule, second schedule. We have seen first schedule for imports. We have seen second schedule for exports. In terms of rules, HSN, as I've said, my rules of interpretation say there are 6 rules. For classification, the goods which enter into India, there are 6 rules which have defined how do I identify a particular commodity. And there is a general explanation, 3 general explanations were given how to identify those classification. And this interpretation of rules and this explanation, these 2 are integral to my Customs Tariff Act. That means I have to apply this particular rules for the purpose of classification. I'll give you a simple example why we have to study this particular rules of interpretation. Examination, I don't see reason why this should be tested in your examination. This is just for your academical interest. I'll give 3-4 examples why we have to read this particular rules. First example. Say a particular blade is imported. When I say blade, a blade which is imported, I can use the blade for sharpening my pencil. I can use the blade for shaving purpose as a razor blade. I can use the blade in industrial purpose for cutting off tools or commodities. I can use the blade for a particular surgery purpose. So when I say a blade is a commodity, I can use it in various aspects. So depending on the usage of the blade, for an instance, a blade which is imported for a surgery, which is of a very precision and very specific make, that blade, I can use it only for surgery. So what I'll do, I classify that blade with a surgery item. So I go with the classification of rules. So identification, what is the common nomenclature, common generic identification, I call that. Example number 1 for blades. Example number 2. Sir, I can import something called box. Like example, my spectacles. When I import a box which is used for packing spectacles, how do I classify that box? Can I call that as a box called packing box, which is classifiable at 12%? Or shall I classify this box, which is meant for storing spectacles, with a regular rate of 18% applicable for spectacles? So packing material when I import. Third example. Sir, I import something called fabric, which is a textile product. This textile product, I can use it for personal use, I can use it for industrial use. If I use it for personal use, the rate of tax is 12%. If I use it for industrial use, the rate of tax is 18%. Like your, what do you call this concentrate, ethyl alcohol. This is a mutilation of ethyl alcohol. So depending on the usage, the rate of classification depends. This is the importance of my interpretation of rules. Moving further. Now, as of today, if you see your Customs Tariff Act, there are 98 chapters, which is grouped into 21 sections. I'll just show you this. if you look into this first schedule, there is a reference called section 1. So this tariff item 04, it starts from 01. Let me go up. Look at here. Section 1 over here has got a reference of 0101. And if I go to the end, I can see 98. So this tariff is heading with 98. And you can see classification of section 21. So as of today in India, 98 chapters are there, 98 of tariff headings, which is put into 21 sections. This is a way how a classification was done to your tariff act. My first schedule consists of 98 chapters and 21 sections. And each section is grouped into various chapters depending on the class of goods. And each chapter has got various sub-chapters, which is again refer to various particular class of goods. So my entire tariff was brought into section 21 sections. Each section, if you see, there are various chapter, sub-chapters. And every chapter, there's something called chapter notes. What is that? This is English, which gives a importance to the part of that particular entry. And this has got a legal authority to say where the goods have to be classified. So the important point or the heart of my classification, I could say chapter notes. When I look into my tariff heading, chapter notes gives me a meaningful interpretation. I'll come back to first schedule to show you this. Now, you can see here, this is called chapter notes. I'll not go merely with this nomenclature. I think Naveen asked this question. So what is the difference between project imports and your protective duty, right? So this is a preferential rate of duty. This is what I think Naveen has asked. So any chapter you see, students, there is something called notes. What is this notes do? They explain, they clarify. When you're looking into your tariff heading chapter 98, these are the information. This is the base for my interpretation of classification. Just because your name is found here, you cannot do a classification. On the basis of this, you go inside and read this chapter notes, and this gives you clarity for identifying the commodity. Now, I was talking about 3 notes. I explained dash, single, double dash, 3 dash. So when I look into my classification, this single dash gives me a heading. Second dash gives me below the heading what is the particle. The third dash gives me for the heading and the second heading the classification. Now, quickly let's look into the rules. I'll not take much of time. Now, rule one, it says, look, don't go with the nomenclature. Don't go with the heading. Go with the chapter notes. Based on the chapter notes, the terms which are used in these headings, that has got a base for interpretation. Always don't go with the title of a section, chapter, or this. On the basis of the terms which is used, the nomenclature which is used under that heading by way of a chapter notes, this has got a basis. So rule 1 says that don't look at the heading and do a conclusion. From the heading, please come to your chapter notes. On the basis of chapter notes, do a classification. This is your rule number 1. Going further. Rule number 2. Sir, I could have a commodity where it is either incomplete or unfinished. Don't worry. Whenever there is a reference for this unfinished or incomplete, it can be identified as a complete form where there is a reference to a particular article. Like example, sir, I have a cap and a refill. A cap and refill when I have to use conjointly for a pen. So I can classify these loose articles which can be combined with an article, and then you go with that particular article for the purpose of classification. So I can bring in unassembled form or disassembled form. Don't worry. When you do the assembly, when you do the complete, there is a finished article which is formed. You go with that particular classification. This is your rule number 2A. Rule number 2B. Sir, in addition to that, there is a mixture or combination. I have a composition of those goods. So when you have a composition of those goods, the material or substance which gets evolved combining these articles together. Like example, sir, I have what you call mobile. I have a charger, mobile charger. I have this handsets. Handsets which is used for listening. I have a mobile charger which is used for power charge. I have a mobile. So when I have three combination, I have a classification. All these three put together can be used with a reference to mobile. Please classify as per that. So it is not possible because it can be used multiple ways. This mobile charger can be used for TV charging or handset. Then don't worry, go for rule 3. Rule 3, in a simple fashion, they say, look, that description, if you look into this particular commodity, what is the general description you get? Go with that general description. Sir, if I don't go with the general, if it is not possible with the general description, then go with the characteristics of the material. Is it an electronic gadget? Is it a manual gadget? Based on a particular common nomenclature, go with that identification. Or, sir, it is not specific, it is not in general. Then you have entry 1, entry 2, entry 3. When you look the entire first schedule, say there are 3-4 entries in the first schedule. The last, which is coming in the numerical order, the last one you pick as a classification. Like example, sir, I have this what you call pebble, which is imported. This pebble I can use as a paperweight. This pebble I can use as a stud in a ring. This pebble I can use it for a decorative product. Now I can use it various purpose. So a pebble which has got multiple things cannot be identified with a specific thing, cannot have a specific character. Look at all the entries. The last entry which comes, you pick that as your classification. This is your chapter 3. Rule 3. The fourth rule. There is a similarity. No, on the basis of similarity, I call akin. Similar goods. Like example, there is a famous judgment, a famous case law under Centlex says Ford versus Maruti. Ford has imported a car in a disassembled fashion. Initial days when Centlex was being levied, Maruti has manufactured cars in India. Ford has imported those cars. Now Ford said, sir, it is a disassembled form. Then Rule 4 was applied by Supreme Court and saying, look, this is having a functionality of a Maruti. So please classify this as your Maruti. That is your motor vehicle. Fifth rule, specific classification. Use the purpose. Like I was talking about the box for the spectacles. If this particular commodity has got a specific purpose, please link with that. Sir, no, it is not having a specific purpose. It is a common packing material. It is a common container. Like example, when I import gas, LPG cylinder, I have a cylinder which is a carrier of gas. After the empty, gas is empty, this becomes empty cylinder. So in those cases, you identify that cylinder as a cylinder for the purpose of classification. This is my rule 5, which is a generic rule for containers or carriers. Last and final, I have rule 6. What it says, a relative application of a section or chapter notes within a heading or a subheading. What they say, when you identify a commodity with a particular characteristics in that particular heading or subheading, please apply that logic only within that heading. Don't carry this logic to some other heading or interpretation. Like in case of a mobile, I have a charger, I have a headphones, I have a handset. If I apply a logic with the particular chapter 84, don't apply the same analogy for chapter 85. So any particular application for a particular heading or a subheading should be suited with that particular heading or suiting. Now, This is my classification, which is covered under classification. As I said, students, examination point of view, not that particular importance. This is just to give you understanding of your importance. I've covered various practical case laws for your just reference purpose. I brought this classification which went to Supreme Court to identify how to identify a particular commodity. Like this case, a material which was imported. Is it a fabric? Is it a resin? Is it a textile? Now, first image you can see a fabric. Second image you can see it is a resin. And third image you can see it's like a textile. So when a particular commodity was imported, how Supreme Court did a analysis for these various commodities. And law of interpretation, like when it which comes at the last entry. Now, this is again in relation to put to use theory, Rule 5 application. Now, with this, we come to the end of today's discussion. Paucity of time. If there are any questions, please excuse me. Next session, I'll take up your questions which are not answered. And we are going to meet again on 12 to discuss on important aspect called valuation. I would recommend students not to miss your next session on valuation. Till then, good night, goodbye, and Jai Hind.